this video, we'll discuss the calculation of interest rate for short duration instruments. Debt instruments with a maturity of less than 1 year, these are short-term instruments like treasury bills and treasury notes, are discounted and the interest rate calculation is carried out in a different manner. Think of a T-bill with 60-day maturity. The bill is issued at 99 and at the maturity 100 principal or face value amount will be received. The formula to calculate the yield or interest rate on the bill is as follows. The interest is P1, which is the amount or proceeds received at maturity. P0 is your current price or investment in the instrument. N is the number of days to maturity, like in this case 60 days. And 365 is the total days in 1 year. So the interest or yield calculation goes like this. Interest equal to P1 minus P0 upon P0 into 365 upon N. P1 is 100, P0 is 99 and 365 by 60, N was 60. Now in some cases you may also see 360 here and the interest rate is 6.14%. So it is more like a simple interest calculation rather than that compounding thing. This is the convention for interest calculation on short duration instruments that are of maturity less than 1 year, like treasury bills and notes. In this video, we'll introduce the law of one price with bond cash flows. Consider three bonds with prices PA, PB, PC, and it is given that all three are government bonds, so they are purely risk-free bonds with same risk-free rate or same risk-free profile. Think of an argument can we construct by mixing bond B and C to create cash flows that are similar to bond A. The idea is simple. We are trying to invest some weight XB in B and XC in C to generate cash flow same as bond A, which means XB into 5. So XB is the fraction or proportionate amount invested in B plus XC into 100. So which is this and this equal to first year cash flow 10. Similarly, XB into 105, which is this, and XC into 0, which is this, equal to 110. Solving for these values, we get XB equal to 22 by 21 and XC equal to 1 by 21. So the total amount invested in B and C is this. These are the investments in B and C to generate cash flow similar to A. So this is the investment in B and C that will result in same cash flows as A. Now, what if the price of A is not same as this price, which means that this investment would result in the same cash flows as PA. However, if the prices are not same, that will result in arbitrage, riskless arbitrage opportunity. Why? Because whether you invest in this bond portfolio or this bond A, you are entitled to the same risk-free cash flows with very similar profile. Therefore, their prices should be same. But what would happen if PA is greater than this price of bond portfolio or PA is greater than this price of this bond portfolio? The law of one price suggests in this scenario that two assets, in this case, one is PA, the other is this bond portfolio. If they have the same cash flow profile in terms of risk and nature of cash flow, they should have the same price. That means PA should be precisely equal to this. Otherwise, skilled investors will buy the cheap asset and sell the costlier asset and make riskless profits. This is called riskless arbitrage. That means they can, if PA is greater than this, they can buy this and sell this, or in other words, short sell this, or they can, if this is greater than PA, then they can short sell this and buy this to make riskless arbitrage. There are some important assumptions here. For example, absence of frictions like taxes and transaction costs. That is important for this kind of purely riskless arbitrage to take place. In practice, because of these frictions and taxes, there is no arbitrage that is purely riskless. So while this arbitrage argument is a theoretical argument which assumes the assumption of transaction cost and frictions like taxes, risk profile of bonds, it assumes that all the bonds are exactly identical in terms of their risk. However, even if two bonds are identically rated as AAA or BB, it does not mean that their risks are exactly identical. Also, investors may have taste and preferences. Even though everything else, there's no transaction cost, the risk profile is identical, investors' taste and preferences may differ across two bonds depending upon their liking. For example, some people may not like to invest in tobacco stocks. So their preference for tobacco stocks is not driven purely by financial fundamentals, but their own taste and preferences. So these factors may also affect the interest rates offered by these two instruments or the pricing of these two instruments. To summarize, in this video, we introduced the concept of law on one price for the bond cash flows. We noted that if two bonds or two instruments of similar risk, similar cash flow profile, they should ideally sell at the similar rate. However, there are certain assumptions behind it, such as transaction cost, risk profile of these instruments, and investors' taste and preferences. In the next video, we'll try to implement this arbitrage argument in a mathematical manner. In the previous video, we introduced the concept of law of one price and also introduced the arbitrage argument in the context of bond cash flows. In this video, we'll examine this arbitrage argument in more detail. Recall, we discussed three bonds A, B, C, which were government bonds with a pure risk-free profile, and their cash flow profile is given here. Now, suppose the risk-free discount rates or interest rates for period 1, 6%, period 2, 7% for year 1 and 2. Also, we'll assume 6 monthly compounding. For argument's sake, let's assume 6 monthly compounding. So this 6% interest rate will be like 6% divided by 2, 3% compounded semi-annually 2 times, and so on. Now we are saying that because the risk profile is identical, year 1 cash flows can be discounted by 6% and year 2 can be discounted by this 7% rate because of law of one price, which says that if the risk profile is identical, whether the cash flow is from bond A, B, or C, it can be discounted at the same spot rate. So we need to solve the following equations. First, we need to calculate the price of bond PA. This PA should be equal to, these are the cash flows for PA, so it should be equal to 10 upon 1 plus 6% divided by 2 plus 110 upon 1 plus 7% divided by 2 raised to the power 2. In an identical manner, we can calculate the price of bond B, which is 5 upon 1 plus 6% by 2 plus 105 upon 1 plus 7% by 2 raised to the power 2. And similarly, you can calculate for bond C, price PC equal to 100 upon 1 plus 6% by 2 plus 0 upon 1 plus 7% by 2 raised to the power 2. This will be your price PC. Now, once you have the price of bond ABC, the arbitrage portfolio that was a mix of B and C in these proportions, 22 by 21 into PB plus 1 by 21 into PC, that can also be calculated. Solving these equations, we find that PA equal to 112.39, PB equal to 102.87, and PC equal to 97.09. Now you can mix PB and PC in this proportion, 22 by 21 into 102.87 PB plus 1 by 21 into PC, which is 97.09, which is the total works out to 112.39, which is same as 112.39. So we can see the arbitrage portfolios have the same price. So let us conclude our argument. So we found that after discounting PB, PA, PC, we found the price of these respective bonds. Then we mixed them in appropriate proportions to find the portfolio PCV, which was the arbitrage portfolio against bond PA. And we find that their prices are identical, 112.39. This could be possible because there are no frictions and transaction costs. And in a coincidental manner, we find that their prices are identical. That means there is no possibility of arbitrage. That means whether you buy or sell A or PCB, there is no arbitrage profits. Now, in this case, we discounted using spot rates. You could have also derived forward rates F12 using S01, S02 using the techniques that we described earlier. And these forward rates can also be used to discount the cash flows. To conclude, in this video, we implemented the arbitrage argument across the three bonds ABC and bond portfolio PCB. We found that the prices are similar, which is in agreement with law of one price. That is, if two assets have similar cash flow profiles and risk, their prices should be similar. Now, in this case, since they are same, there's no arbitrage opportunity. But had it been the case that one of them was higher than other in a relative manner, then there would have been arbitrage opportunity. The asset that would have been overpriced, people would sell that, and the asset that was underpriced, people would buy that. And because of this demand supply change, these prices would realign and again come back together. This is our typical arbitrage argument. In this video, we'll understand the determination of spot rates from the bond cash flows. More specifically, we'll consider government bonds and determination of risk-free spot rates and the corresponding term structure. Let's start with a simple example where we have a bond A, which is, think of it as a strip which offers a cash flow in 1 year of 106. Think of semi-annual compounding and price of 100. Now, the basic idea here is that if there were to exist some spot rate S01 for risk-free instruments, then if you discount it, that is 106 upon 1 plus S01 by 2, it should result in price 100 if the market is efficient and fairly valuing this cash flow. Given that the price is 100, this relationship holds. Now, after discounting this, we find the value of S01 is equal to 2%. Since this semi-annual compounding setup, we the actual discount rate for 6 month period is 6%, 12% divided by 2. So this is the first year. Now suppose second year there's no strip available. Had it been the case that strip was available, then our job would have been much easier. We could have simply applied those strip on the cash flow C and divide by 1 plus S naught 2 divided by 2 raised to the power 2. This would have been the price. But that is not available. So we have a bond B, which has two cash flows, 6 coupon, second year 6 coupon plus interest. So we'll discount these cash flows. For first year spot rate already known to us, which is 6%. So 1 plus 12% by 2. So first year cash flow is known. The second is 106 upon 1 plus S naught 2 divided by 2 raised to the power 2. And the price is known to us 96.54. So when we solve for this, we get a value of S naught to S 16%. We get a value of S naught to S 16%. This is our second year spot rate. Now in this fashion, you keep finding bonds which are strips, and even if it is not strips, you can one step by step, you can discover the full spectrum of interest rate across different maturities. And once you have that, you can plot them with maturity and interest. This would be your term structure of spot rates for the risk-free bond. In this fashion, you can have a set of bonds and derive these spot rates. Practically, bonds are not identical the way they are described theoretically. For example, as maturity increases, different risks such as maturity risk premium and so on is added. So while theoretically the spot rate is a pure risk-free rate, however, practically there may be differences in spot rates that are estimated. Second, why these spot rates are important, or more specifically, that this term structure of spot rate is important, because once you have the risk-free spot rate for a given maturity, let's say time t, if you want the risky spot rate for a different risk category, double A, triple B, you can keep on adding to that risk-free rate. You can keep on adding the risk premia for the appropriate risk that you want to assess, and get the term structure spot rate for the risky instruments. So that is why this risk-free spot rate term structure acts as a benchmark and is a very useful, its discovery is very useful in financial markets. In this video, we'll introduce the theories that explain determinants of bond prices and the theoretical underpinnings. We'll also introduce the theories of term structure of interest rates. To begin with, there are various factors that affect bond prices and their yield to maturity, YTM. Some of the important factors include credit and default risk, maturity risk, taxation of cash flows, premature redemptions, coupon payments, and so on. Now, there are certain theoretical underpinnings or theories that provide the background to these factors and their relationship with bond prices. These theories include theory of term structure and term to maturity, market segmentation theory, pure expectations theory, liquidity premium theory, and preferred habitat theory. Let us start the discussion with theory of term structure and term to maturity. According to the theories of term structure, interest rates vary with time to maturity. For example, if there are bonds, with the maturity of bond, the yield curve may increase or decrease like this. This is called term structure of interest rates. And the theory of term structure of interest rates suggests that interest rates may be different from short term to long term. This has a lot of implications for bond prices. For example, a bond which has cash flows occurring over different time periods, short to medium term, they may be discounted at different rates, and depending upon the cash flow profile of bond and its risk, the prices may differ considerably. Let's understand this, for example, why the term structure of interest rate may be rising or falling. Think of a situation where economy is booming, inflation is rising, and economy is heating up. The government would like to tighten the interest rate, and generally the interest that is in control with RBI in India, and therefore the government, is short-term interest rates. When short-term interest rates are tightened, market expects the long-term interest rates to rise as well. So as the government tighten the short-term rate, the expectations of long-term rates also tighten in expectations of increasing interest rate, and you may observe such kind of rising yield curve or term structure. For example, if you go to your SBI account and you click on the interest rate profile, you will find a rising kind of interest rate which may flatten in long term, but it may be rising. Similarly, think of a crisis period where economy is slowing and government needs to sort of give a push impetus to economy. It may decrease the interest rate. This decline in interest rate may sort of give the much needed push or impetus to economy, and in that case the market may expect the long term interest rate to fall also. The government sort of decreases the interest rate, loosens the economy. The term structure may appear like this. So in this video we explain the term structure of interest rates and its profile, why a rising versus falling term structure may be observed. In this video, we'll discuss the market segmentation and preferred habitat theory of interest rates. The theory argues that investors are risk averse and they have a preferred maturity bucket or what we call as preferred habitat. We all know that the sensitivity of interest rate to any project or any firm or any instrument depends upon its cash flow profile. A firm may have long-term cash flows or short-term cash flows, and accordingly its risk of interest rate sensitivity. For example, think of an insurance firm. Generally, its liabilities or policies are expected to mature after sufficiently long horizons like 20 years. And therefore, these companies would like to match the asset liability of their profile. For example, they would like to prefer their assets to be of long term, like long term bonds, and therefore minimize the interest rate risk, exposure to interest rate. So they would not prefer to invest in short terms, which would expose them to interest rate change risks. But who would be the issuers or subscribers to these long term debt? Company like ONGC and similarly other plant manufacturing or oil and gas exploring industries where the gestation periods of project is very large and they would require long-term funding to maintain their projects, they would be subscriber to these bonds. In this fashion, we have identified a set of market segment, both issuer and investor to instruments like bond in long, short, and medium-term maturity buckets. Now, in a market, the prevailing interest rate at different maturities would reflect the supply and demand at given maturity. So, for example, if supply is higher in a particular maturity and demand is less, interest rates may fall. And similarly, if supply is less and demand is more, interest rate may rise. This is also called preferred habitat theory because it suggests that investors have a preferred habitat of maturities of their asset liability profile. They would like to match the maturities of their assets with liabilities so that they are least exposed to interest rate risk. Now, if you want to induce them to hold assets of other maturities, or for example, you want them to buy assets of different maturities from their liabilities, you need to pay them extra premium because you are exposing them to interest rate risk. For example, if a large number of firms are issuing long-term debt and a less number of interested in long-term debt, then a premium has to be offered by these long-term issuers to induce more and more investors. This is slightly in contrast to liquidity premium theory that we'll discuss later, which suggested that it will require extra premium to induce investors to hold long-term bonds. This suggests that in both cases are possible. Unlike liquidity preference theory, which said only short-term is more desirable, the preferred habitat theory suggests that both, whether long-term or short-term, both are desirable depending upon the demand supply of funds in that particular maturity bucket. In this video, we'll discuss the pure expectations theory of interest rates. To begin with, the theory suggests that term structure of interest rates reflect broad market expectation about future interest rate movement. For example, if the term structure of interest rate is upward rising, then expectations are that interest rate will rise, and if it is inverted like this, then market expects the interest rates to fall. Now, this also means that expected rates in future will be higher in the case of rising, and expected rates, spot rates in the future will be lower than what they are today. And these expectations are captured in the current forward rates. So what this theory suggests is that current forward rates reflect the expectation of future spot rates. Let us see how this works. Suppose the current spot rate for 2 period is 12%. If you're thinking of 6 monthly period, then this would be 1 year. Or if you're thinking of, let's say, yearly period, then this would be 2 year. Now, one period, let's suppose one period interest rate is 10%. So assume them to be 6 monthly rates. And the forward rate for 6 month to 12 month is 16%, which is committed today. Suppose I invest in S02 for 1 year, then I am entitled for an effective rate, which is for 12 months is this, which is 12.4%. Suppose one does not want to go through this route, but would like to invest for 12 months using the forward rate. The option is to invest in S01, which will be 1 plus 0.1 by 2, and roll over the investment at today's committed rate. So commit today with a forward rate of 16%, you'll get this one. Now, effective rate in this leg or this channel of investment is 13.4, which is clearly higher than 12.4. That means there is a possibility of arbitrage. Let us discuss the nature of this arbitrage. Suppose if many investors observe this, what they will do is they will borrow in this investment. They will borrow this interest rate. How to borrow this? So borrowing means effectively shorting. So they will short this investment and effectively they will borrow at this rate and invest in the higher one, which is this, which means they will go long in this instrument. Now, if more and more people will do that, the overvalued instrument, which is this one, as more and more people will sort of sell it, it will fall in price and the interest rate will rise. In contrast, in this instrument, which is offering a higher interest rate, more and more people will invest. Its price will fall, and relative to this, the price will fall relative to this, and more and more people will invest. The price will rise and interest rate will fall relative to this, and they will be well aligned. To summarize, a large number of investors will sell the 2 period bond and buy in the rolling over strategy through forward rates. That is, buy one period and then roll it over at forward rate. So invest in through forward rate channel. This will cause the 2 period interest rates to rise, that is falling prices of 2 period bond as we discussed. Thus the price of 2 period bond and bonds of other maturities will reflect the current expectations. So effectively these expectations are captured by forward rate, and different spot rates have to well align with the forward rates. So according to expectations theory, the expected spot rates in future will be same as forward rates observed today, and that is why the computations of expected spot rates are expected to be similar to those of forward rates as per this theory. In this video, we'll discuss the liquidity premium theory or liquidity preference theory of interest rates. This theory suggests that investors demand some additional premium to hold long-term bonds. The reason is that there's more long-term uncertainty. There's more uncertainty in long-term, and therefore, when you are requesting investors to commit money, they prefer short-term commitments because there's more uncertainty, unknown aspects of long-term. So they prefer less the long-term commitments, and therefore, if you want to or push them to hold these investments, they would require some kind of additional premia, and that is why long-term interest rate generally would be higher than short-term interest rates in order to compensate investors. For example, if an investor has a preferred 6-month horizon, in order to make them hold 1 year investment bond, you need to offer some premium. Similarly, to offer 2 year bond, you need to hire even a higher premium. This suggests that investors can earn extra premium for holding long-term bonds without having to bear any other credit risk. This is simply called liquidity premium. Let's look at the implication of this liquidity premium. For example, if the original term structure is expected to be flatter, because of the liquidity premium, it can pull it slightly upwards. For example, you can see as time to maturity increases, the liquidity premium is higher. Similarly, even if a term structure of spot rate is falling originally, so these are declining expectations of interest rate, the liquidity premium can further push it upwards and make it even flatter or even upward sloping, depending upon how much premium investors are putting towards liquidity. This is also often called flight to liquidity and flight to quality. When financial markets are falling, investors prefer instruments that are more liquid and safer. In this video, we'll try to understand the term structure of coupon paying bonds. Instruments such as pure discount bonds or strips, separately traded registered interest and principal securities, it is easier to calculate the interest rate. For example, suppose a strip or a pure discount bond which is traded at price P naught, and in future some face value or principal amount, that is, let's say P1 is expected, or rather PT at time T after T periods, let's say T years, and assuming semi-annual compounding, let's say interest rate is R, one can compute this interest rate R simply as PT upon 1 plus RT by 2 raised to the power T into 2 if it is semi-annual compounding. In case it is annual compounding, then P naught PT upon 1 plus R raised to the power T. The idea here is simple, that because there is only one cash flow, calculating this interest rate using the price, current traded price, and future expected cash flow is easier. However, it is not as simple for typical coupon paying bond where there are multiple cash flows, multiple coupons occurring over different time periods along with the principal payment, and there is a term structure of interest rate. That means different interest rates apply to all these coupons. So how do we find the term structure of pure coupon paying bonds? Consider a 3-year maturity bond A with a coupon of 75 and principal 1000. This portfolio of bond can be considered similar to a three pure discount bonds A1, A2, A3 with cash flows of 75, 75 in first, second year and 1075 in third year respectively. Now the price of this portfolio of three bonds should be same as the original bond by law of one price if they all three of them are of same risk, let's say purely risk-free bonds. The yield of these three bonds should be the spot rates for 1, 2, and 3 years respectively. So this is the intuition behind generating the term structure of coupon paying bonds. For the single bond, so its price can be calculated as discounted value of coupons, that is 75 first coupon discounted at first year spot, 75 second coupon discounted at second year spot, and third coupon discounted at third year spot. Also, please note that individually discounted cash flows, for example, this particular cash flow discounted at spot rate S1 would reflect the price of A1. This cash flow 75 discounted as S02 will reflect the bond A2 price, and this should reflect price A3. And it is also easy to understand why this S01 should be the yield for A1, S02 should be yield for A2, and S03 should be yield for A3. In this backdrop, if you know the values of S01, S02, S03, the term structure of a pure discount bond is easier to understand because these will be the respective yields for applied to individual cash flows. So the first cash flow will be discounted at this rate, first year cash flow, second year, third year cash flow will be discounted at this rate. And if the overall term structure is falling of this nature, then it is not too difficult to argue that the term structure for pure discount bonds, any of the pure discount bond would be like this, which is very easy to understand because first year cash flows will be discounted at S01, which is greater than S02, which is greater than S03. So the term structure for pure discount bond should be declining itself. Now, let us try to derive the term structure of coupon paying bonds using the information that we have about pure discount bond. Let's start with a high coupon paying bond. High coupon paying bond is another extreme end of pure discount bond. So pure discount bond, there are no coupons. For high coupon bonds, a larger proportion of cash flows is coming earlier in time. That means a larger fraction of cash flows are earlier in time. And because we have assumed that the term structure in general is falling for pure discount bonds, therefore a larger fraction of cash flows for high coupon bond is discounted at higher rates. And therefore, while a lower fraction, which is the principal is or later cash flows are discounted at lower rates. So it is typical to understand that the high coupon bond would be another extreme. The term structure would be much, much above. Contrast this to a low coupon bond, which is closer to the pure discount bond because a larger fraction of cash flows are appearing later in time, and these cash flows would be discounted at lower rates. So as compared to higher coupon paying bonds, on average, it is not too difficult to understand that its term structure would be lower. Why? Because a larger fraction of cash flows are discounted at lower interest rate as compared to high coupon bonds. So to conclude here, if one assumes a declining falling term structure of interest rate, then the profile of high coupon paying bonds relative to low coupon paying bonds would appear like this. The high coupon bond paying bonds would be higher in terms of interest rates or yield to maturity as compared to pure discount bonds, which are closer to low coupon paying bonds. So ceteris paribus, if you have two bonds, one is low coupon paying bonds, one is high coupon paying bonds with identical maturity, the term structure of interest rate would suggest that yield would be higher for high coupon paying bonds as compared to low coupon bonds. Now the same logic we can apply in the case of rising term structure. Again, the idea is simple. In case of rising term structure, think of a pure discount bonds, compare it with high coupon bonds. For high coupon bonds, a larger amount of cash flows, tend to appear or occur earlier in time and therefore discounted at lower rates, while a smaller fraction, which is the principal, which comes later, is discounted at a higher rate. So overall, as compared to a pure discount bond, its term structure should be lower. Similar to pure discount bond, for low coupon paying bonds also, a major fraction of cash flows appear later in time, which is discounted at higher rate as compared to a smaller fraction, which is appearing earlier in time, which is discounted at lower rate. So as compared to high coupon paying bond, the interest rates on low coupon paying bond would be higher. For example, think of two bonds, one high coupon and one low coupon, ceteris paribus with same maturity. The only difference is in coupons. Then you can imagine the yield of low coupon paying bond would be higher because majority of the cash flows are discounted at higher rates as compared to high coupon bonds where majority of the cash flows are discounted at a lower rate. So to conclude, in this video, we discussed the term structure of coupon paying bonds with the help of pure discount bonds. We noted, depending upon whether the term structure is rising or falling, the yield to maturity or term structure of low coupon and high coupon paying bonds may differ. When the term structure is falling, the low coupon paying bonds have lower term structure of interest rate as compared to high coupon paying bonds. In contrast, when yield to maturity is rising, the low coupon paying bonds have a higher term structure of interest rate as compared to high coupon bonds. In this video, we'll discuss some of the other auxiliary factors affecting bond prices. First, default risk. Unlike government bonds, private corporate bonds involve considerable default risk, that chances that they may miss out on their coupon or principal payments. And therefore, a corporate bond with identical cash flow profile that of government bond is expected to offer yields to compensate for this default risk. This extra return offered by these private corporate bonds is called default premium or spread. The second factor is taxes. Bonds with certain tax advantages offer slightly lower yield as compared to other bonds with similar risk profile but not the specific tax advantage. The reason is that tax-free bonds have a specific niche clientele like wealthy high-income investors that are in high tax bracket, and they can enjoy or take benefit out of the tax advantages offered by these such bonds with tax advantages. Next, we have bond with option-like features like callable bonds. These are similar to options. For example, a callable bond can be called back by the issuing firm. Let's take an example. Suppose there is a particular strike price at which the firm is entitled to call the bond back. For example, if prices are rising and the strike price or the exercise price is lower, firm may call back the bond which is at a higher price currently at a cheaper exercise price. So this puts the subscribers or buyers of the bond at a disadvantage, and therefore for such bonds the issuing firm needs to provide a certain call premium, some additional interest for investors to motivate them to buy such bonds. Next, you have floaters. Floaters are the bond with interest rate linked to some kind of floating benchmark and some additional spread to account for various risks. Now, please note such floater bond may put the subscriber to interest rate risk and give some benefit to the issuing firm. For example, if there is a chance that interest rate may vary a lot, for example, suppose the interest rate fall, this gives the benefit to the firm of falling interest rate. However, this also puts the investor at certain interest rate risk, because while they may have bought the bond at certain interest rate, depending upon changes in future which are unexpected, the interest rate may change, and therefore subscribers may want some extra interest. However, the situation can be reversed. For example, if investors expect the interest rates to rise, they may prefer these floaters, and if they expect the interest rates to fall, they may not like the floater. So depending upon the demand supply scenario, the firm may have to offer a premium or discount. As may be the prevailing demand supply scenario, the firm may have to offer us discount or premium on such floaters. Bonds often have CDS features attached to them. CDS is like a default insurance instrument, credit default swap. So for example, if a bond has attached CDS and the issuer of the bond defaults, the subscriber or investor in the bond will be compensated from the insuring party that has issued the CDS. Now, because of this extra feature, the bonds that are issued with attached CDS, they demand some extra premium to be paid for this feature. That that means investors have to pay certain extra amount for this feature. There's something similar to a typical insurance product. So when the issuer of the bond defaults, the insurer who has issued the CDS on the bond will have to compensate the investor for the loss. So how to price this CDS? The idea is that with the CDS attached, the bond become almost risk free. So the price of CDS should reflect that difference between a similar risk profile private corporate bond and a government bond, with only the difference between them being the default risk. Lastly, there is another very interesting instrument called collateralized mortgage obligations. Such bonds are created by securitizing the pool of mortgage-backed cash flows in an economy. For example, you can assign these cash flows based on some kind of priority like a waterfall structure. So when the cash flow comes, the top rated or there's a certain set of bonds that will be given the first priority. Then once these initial priority are paid, the waterfall or the remaining cash flow will go to the next priority bonds and so on. So the bonds that get earlier priority, they are rated higher. However, this is has its own risk or hazards. For example, in 2008 subprime loan crisis, we saw that because all such bonds defaulted, all such issuers defaulted because they did not get their home loan repayments, irrespective of the hierarchy or the priority, even the higher rated instruments also defaulted. To summarize, in this video, we discussed various factors, auxiliary factors that affect bond yield, such as attachment of CDS, option-like features, tax benefit, risk of the bond like private or government bond, and so on. Now let us summarize this lesson. Fixed income securities are predominantly classified as government securities, private corporate bonds, mortgage bonds, and municipal bonds. While the government securities are often considered as low risk, particularly for strong economies like the US and UK, private corporate bonds are relatively riskier. A typical fixed income security like a bond offers interest in the form of annual or semi-annual coupons and the principal at the end of the maturity. Another class of security is called STRIPS, that is separately traded registered interest and principal securities. These are individual cash flows that are stripped from the coupon paying bonds traded as independent securities. The discounted present value of bonds cash flows reflect its price, which is expected to be the same as traded price in efficient markets. A bond's yield to maturity is the return if it is purchased at the current price and held till maturity. This yield to maturity captures a complex weighted average of term structure of interest rates prevailing in the environment and changes as the interest rate environment changes. However, yield to maturity, that is YTM, from two bonds are not comparable, as the YTM calculation assumes that the intermediate cash flows are reinvested at the same rate as bonds YTM, that is yield to maturity. Now, law of one price suggests that $1 in future coming from bonds A and B with similar risk profile should be valued today in a similar manner. That is, the same discount rate should be applied and not depend on individual investors' tastes and preferences. Spot rates are interest rate contracted today for lending borrowing operations starting from today, that is present. In contrast, forward rates are interest rates contracted today for lending borrowing operations in some future time periods. By the arbitrage argument, spot and forward rates are aligned to each other and cannot diverge too far. The following theories of term structure provide for the shape of term structure of spot and forward rates. According to market segmentation theory, the demand supply of funds is divided across maturity buckets. Individual investors try to match their asset liability profile, and accordingly, the supply demand clearing results in the interest rate term structure that we observe. Next, we have expectations theory, which suggests that forward rates today reflect the expectation of spot interest rates in future. Then we have liquidity premium theory, which suggests that investors demand a liquidity premium for holding long-term investments compared to short-term. Finally, we also discussed the term structure of coupon paying bonds. We noted that for falling term structure, the high coupon paying bonds have a higher term structure and vice versa for rising term structure of interest rates. We'd also discussed other factors affecting bond prices, including default risk, taxes, bonds with option like features, floaters, bond with CDS attached, that is, credit default spread, among others.